Hi guys, welcome back to my YouTube channel. So in today's video, we are going to be doing chapter 26. It focuses on money, price level, and inflation. So before we continue, please take a moment to click the subscribe button. Please don't forget to comment, like, and share. So as I said, today our main focus is money. So let us first define what money is. People tend to say a lot about money. Money is something we all want. Money is something we always talk about, right? But what exactly is money? So money is a commodity, right? But what is a commodity? So in economics, when we say commodity, we mean an economic good. It is a resource, right? And this resource is seen as valuable and it can be sold or bought, right? So money is a commodity. It is a resource, right? That is valuable, that we value as a society. So money is a commodity, a resource that we value, and is generally accepted as a means of payment. So money is what you can use to buy goods and to pay for goods, right? So it is a commodity that is acceptable. You can't just use anything to pay for goods and services. You need to use money because this is what is acceptable as a means of payment, right? Money has three uses. First of all, it is used as a medium of exchange. So it is used as a medium of exchange. Secondly, it is used as a unit of account. Thirdly, it is used as a store of value. So let's go over these three uses in detail. When we say it is used as a medium of exchange, let's first define what a medium of exchange is. We say that a medium of exchange is any object that is accepted in exchange of another thing, right? So this is an object that you can exchange for something else. So you exchange the money to receive the goods and services, right? But this is to exception with things like debit cards, credit cards, as well as checks, right? Let me repeat. So we are saying that money is something that you can exchange and receive something else as a result, right? So you can give someone money and they give you goods and services, but you can't give someone money. You can't give someone a debit card or a credit card and they give you goods and services unless that debit card has money. So do you see how debit cards and credit cards are not money, right? They are an instrument that you use to reach to the final goal, to the final thing that you need, which is money, right? So you might have a debit card, but it might not be money, might not have money, right? So a medium of exchange is any object that is accepted in exchange for another thing. Secondly, money is used as a unit of account, right? What does unit of account means? Unit of account means that it allows you to value your goods, right? It would be hard for you to do the system of barter where you have to find someone who wants what you want so that they can give you what you want. For example, if I want a laptop and you want shoes, it would be very hard in this whole world to find someone who matches your needs and you match their needs so that you exchange the goods. So to solve this problem, money came to the rescue and it is used as a unit of account. The third use of money is that it stores value, meaning that you can take goods and pay for money later because it can keep value, right? As much as inflation decreases the value of money, but money can still keep value. Money is still valuable today, money is going to be valuable tomorrow, and money is forever going to be valuable, right? So let us go on. So let us look at money in depth. Okay, so money consists of two things, right? So when we say money, right, to classify money, we classify it under two things. We classify money under currency, right? And then we classify money also under deposits at banks and other depository institutions, right? So let us go over currency. When we say currency, we mean notes, we mean coins that are held by individuals and businesses, not held by the bank, but held by individuals, meaning that these are notes and coins that are in circulation, that are being used in the economy, right? So if money or coins, if notes and coins are held by the bank, that's not currency, right? These notes and coins need to be held by individuals and they need to be in circulation in the economy. They need to be used in the economy, buying goods and services, received as income, used to pay loans, right? So they need to be in circulation. That's what currency is. Secondly, money can be classified as deposits of individuals. So when a person goes to the bank and deposits money, those deposits are regarded as money, as they can be withdrawn and used as a means of payment, right? So let us look at the measures of money, or how we classify money according to the South African Reserve Bank. So we have 3 measures of money. We have M1, we have M2, we have M3. Very easy stuff. M1 is basically your coins and your notes, as well as your check deposits. Check deposits are checks that have been given to the bank and are awaiting to be cleared, right? When a check is not at the bank, it is not money. But when someone has written you a check and you have given it to the bank to be cleared, that's regarded as a check deposit and can be regarded as money. So M1 includes your currency. Currency are your notes and coins, as well as your deposits. When I say deposits, I mean check deposits, right? Then you have your M2. M2 is basically what you have under M1, and you add your short-term and medium deposits. Then you have your M3. M3 is M2. Remember, M2 includes M1, short deposits, as well as medium deposits. So M3 takes M2 and it adds long-term deposits, such as pension funds, right? So I already told you guys that a check deposit is a check that has already been given to the bank and is awaiting to be cleared, right? So do not be tricked in the exam. Credit cards and debit cards are not money, neither are checks. So if you are holding a check right now, you are holding a debit card, you're holding a credit card, that is not money, because you are still going to need to go clear that check by the bank, then it becomes money, right? If you have a credit card is an instrument, right, that allows you to borrow money from your bank and pay it at a later stage. Right, so a credit card and debit cards and checks are basically instruments that bring you to the end goal, and the end goal is to money, right? So you have money and to like gain the money so that you can use it for your transactions. So I talked about depository institutions. So let us look at what these are. So the first one that we have are commercial banks. Secondly, mutual banks, post banks, land and agricultural banks. So you don't need to worry about these 3. But the one that we focus a lot in this syllabus that we are doing are commercial banks. What are commercial banks? You guys probably know this. These are your Absas. This is Capitec, FNB, Nedbank, Discovery, Time Bank, etc. Right? So these are the middlemen. So what they do is that they take people's savings. So you deposit your money, you save your money in this middleman. And this middleman gives you an interest rate. And this middleman takes whatever money that you gave them and it lends it out on loans. But how does it make money? So what it does is that when it gives you an interest rate, because you are saving to it, so when you save to it, you receive an interest rate, right? But it gives you an interest rate lower than the one it charges, right, for their loans. So you will give them money as your savings, and they will use your savings to give out loans. But they are going to give out loans at a higher interest rate than the one they gave you when you saved at the bank, right? So that's how they make money. Hope you guys understand, right? So commercial banks classify the funds or the deposits that they receive into 4 assets. So you are going to deposit the money, and they are going to classify the money that everybody in the world deposited into those commercial banks into 4 assets. The first one are reserves. So reserves, let me explain the whole concept under reserves. So what reserves are is that this is a percentage of what people deposit, right? So what happens is that you deposit money at the bank, so the bank is holding your money. However, the South African Reserve Bank will require the commercial bank to keep some of that money with it so that it can bail the bank out if it is not liquid, right? So reserves, what a reserve is that it is a portion, right? It's a percentage of what the bank has that is kept with the South African Reserve Bank to meet depositors' withdrawals, right? So to bail the bank out if it is not liquid, right? Secondly, it will classify it under liquid assets. So remember that the bank needs to make money, right? And how does it make money? By giving you a lower interest rate and taking your money, lending it to someone else and earning a higher interest rate. So it classifies the money that it receives into 4 assets. Reserves, I've already discussed that one. Secondly, liquid assets. So in the liquid assets are called treasury bills, right? So these treasury bills are sold by the government, right? So they will buy, so they are easily sold, so you can easily convert them into cash. Liquid means you can easily convert things to cash, right? So what they do is that they buy the liquid assets, right? And then they sell them as soon as they need the cash, right? And obviously they are going to sell them at a higher interest rate so that they can make money. Okay, thirdly, we have investment securities. So these are long-term, and as a result, they are riskier. So they are going to make long-term investments so that they earn interest, so that they earn profits and make money, right? Thirdly, they are going to give out loans, right? So loans are the easiest of the four assets because you guys know that banks give loans. But these are the riskiest, and as a result, they are going to have higher interest rates. Okay, let us continue. So why do people value commercial banks or depository institutions? First of all, they create liquidity, right? So you can put your money at the bank and get it whenever you want. So it's very easy to get the money that you want back, right? And they pool risk. Imagine if you were one person and you are an individual, right? And you are borrowing someone money. That is very risky. Unlike when a bank has 1,000 customers, but they are borrowing one person money. So if one person defaults, they still have the 999 people to pay them. But if you were an individual and someone defaulted on paying you a loan, you lost your whole money, right? So they pool risk in that sense. Thirdly, they lower the cost of borrowing. So in the sense that they lower the cost of searching. So so a bank knows that if they want a 2 million loan, they can just go to the bank rather than searching the whole world and looking for someone who is willing to pay them, someone who's willing to lend them this amount, right? So it lowers the cost of borrowing and the cost of search. Thirdly, it lowers the cost of monitoring borrowers. So they have the necessary helpers, like they can check and monitor how risky it is to give you an interest rate and give you an interest rate that aligns with the level of risk that you are as a consumer, right? So that's all about money. However, I mentioned the South African Reserve Bank when I was talking about the reserves, right? I said that the South African Reserve Bank requires commercial banks to actually keep a percentage of what they have with them. But what is the South African Reserve Bank? So the South African Reserve Bank is basically a central bank, right? So this is the bank of the government, right? And the main goal of the central bank is to keep inflation within the targets of 3 to 6%, right? So its main goal is to keep inflation within the targets of 3.3 to 6%, right? So how does it do this? It does this by using what we call monetary instruments, right? And we cover the monetary instruments just now. They include the required reserve ratio, the repo rates, and the open market transactions. So what they will do, remember what causes inflation. Inflation can be demand pull or it can be cost pushed. So what they try to do, let me just summarize what causes inflation. What causes inflation is the fact that you have too much money circulating around the economy. So what the South African Reserve Bank tries to do is to limit the circulation of money so that they keep the inflation within its targets. So how do they limit the circulation of money? They use the monetary instruments, and sometimes you have low money in the economy, so they will use the monetary instrument as needed, either to boost the economy or to contract the economy, right, in order to keep the inflation within the target. So if, for example, the inflation was in a percentage of 2%, they might use expansionary monetary policy and bring the economy up to 3% or 4%. And if it was at 7%, they would contract the economy using these instruments so that the inflation rate can be within the targets, right? But let's discuss the instruments, right? So we say that the required reserve ratio. I discussed this and I said this is the amount of money that the South African Reserve Bank requires banks to keep with them. So think about it. The more banks, remember banks are the middlemen. So banks are commercial banks are in the middle of the South African Reserve Bank as well as individuals. The South African Reserve Bank will make notes, right? and they will be transported from the South African Reserve Bank to commercial banks to the economy, right? So if the South African Reserve Bank is going to require the South African Reserve Bank is going to require the commercial banks to keep more money with it, it means that the economy is not going to have a lot of money, right? So the higher the required reserve ratio, the lower the amount of money is going to be in circulation, and the lower the required ratio, the more money is going to be in circulation. Think about it. If you are supposed to reserve a particular amount of money, are you going to have more money or less money? You're going to have less money. So think about it using logic, right? And then we have the repo rates. The repo rates is basically the rate at which the South African Reserve Bank charges the commercial bank to lend it money. So the higher the interest rates, the less commercial banks are going to want to borrow from the South African Reserve Bank. And as a result, there's going to be less money in the economy. The lower the repo rate, the more commercial banks are going to want to borrow money from the South African Reserve Bank. And then we have open market transactions. So what these are is that the South African Reserve Bank can buy bonds, right? So when they are buying bonds, it means that they are going to give the seller money. So there's going to be money in the economy. But if they are now selling the bonds, right, they are going to receive payment, meaning that they are withdrawing the money from the economy to the South African Reserve Bank, right? So there's another point that you guys should remember, that when there is less money in circulation, so when you have less money in the economy circulating around the economy, the interest rate will increase. Because if you have less money, people are gonna demand more of money, and as a result, banks have the leverage to charge more interest rates, right? So as I said, the central bank uses the monetary policy to adjust the money in circulation, right? And then let us look at the money creation process. Okay, so there are three factors that limit the quantity of money, right? So first of all, the monetary base. What is the monetary base? The monetary base is the sum of all the banknotes. So it's the sum of all the banknotes and the coins that are in circulation, right? Remember, we are talking about factors that limit the quantity of money that a bank system can create. First of all, we set the money base. So if there is less money if there is less money in circulation, obviously the supply of money is going to be less. Then secondly, the desired reserve. So the desired reserve is basically what banks want to keep, right, to meet their business needs. It's what they want to keep with SARB. And obviously it needs to be above the required one, right? I think the required one is 2.5% per rand, if I'm not mistaken. So they might want to keep more based on how their business looks, but they can't keep less because there is a specific minimum that you have to keep with the South African Reserve Bank, right? So we've covered this. And then another thing that would affect the quantity of money in circulation is the desired cash holding. So consumers want to hold some percentage to themselves. You want to have cash that you can use to buy, right, goods and services whenever you want. So that's what desired cash holding basically looks at. So the desired cash holding increases when the deposits increase. So the more you deposit at the bank, the more you might want to keep, right, so that you are able to meet your daily needs and wants, right? And we talk about the ratio of currency to deposit. We talk about the fact that whenever cash leaves the banking system, there is what we call a currency drain. So whenever cash leaves the banking system, it could be in the form of loans, etc. There is what we call a currency drain, right? And the ratio of currency to deposits is called the currency ratio, the currency drain ratio, right? And the higher this ratio, the lower is the quantity of money. Think about it. If there's an increase in the drain of money, then the lower the quantity of money, obviously, right? And then we talk about the money multiplier, and we say that the money multiplier is a ratio of change in the quantity of money to the change in the monetary base. So it is a ratio that compares the quantity of money, the money that you have in circulation, to the change in the monetary base. And we say that the lower the currency drain, and the desired reserve, the higher the multiplier. Think about it. If you have less drainage of money, the more money you're going to have. And when you have more money, the multiplier can multiply the money, right? So the multiplier is going to increase. And in terms of the desired reserve, think about it. If you are reserving less with the reserve bank, it means that you're going to have more money in circulation. And as a result, the money multiplier is also going to increase, right? Hope you guys are understanding. Please don't forget to comment, like, and subscribe. This chapter is quite long. I'm so sorry, guys. And then we look at the demand for money. So now we're going to talk about the graphs, etc. So the quantity of money demanded, we are defining what quantity of money demanded is. We're saying that the quantity of money demanded is the amount of money people plan to hold on any given day. So the quantity of money demanded is what you as a consumer, you as households, you as businesses want to hold on any given day. But what influences what you want to hold, right? It's the price level. Think about it. If the price level had to increase by 10 rand, let's say before it increased, you used to spend 100 rand on your groceries. If prices of goods and services had to increase by 10 rand, do you see that you would want to hold 10 rand more so that you can maintain your standard? So if the price level increases, you will hold more, right? Secondly, the nominal interest rates. So basically what the nominal interest rates is that it is the opportunity cost of holding money, right? It's what you forego to hold the money. So household would rather give the money to banks in order to earn interest rather than keep it to themselves. Because if you keep it to yourself, you earn zero interest. If you give it to banks, you will earn interest, right? And then we look at real GDP. So real GDP is about expenditure. It's about what you are spending. So you will hold as much as you need to spend, right? So real GDP would affect how much you want to hold. And then financial innovation. So financial innovation would also influence, financial innovation would also influence, I just want to see if you guys can still see. So financial innovation would also influence how much you would plan to hold. For example, how quickly you can make payments. If you have online banking, you can make payments as easy as you can. So you will hold less money and have the money in the bank. By hold money, we mean hold cash. So if there are things like online banking, etc., you will hold less money and just have your card or have your phone to make payments, right? So yeah, that's what I was discussing here. And then a very important thing for you guys to take note of is that the higher the expected inflation rates, the higher is the nominal interest rate, right? Because the cost of borrowing is going to be higher. So yeah, let's go on to the curves. So we're talking about the demand of money. So remember, there's a difference between demand and quantity demanded. Demand is the relationship between price and quantity demanded, whereas quantity demanded is what you have on the x-axis. These are the units that you are demanding. So when you talk about the demand for money, we are talking about the relationship between the nominal interest rate and the real interest rate, and it's going to have a downward slope. Think about it. If the nominal, remember we're talking about the demand for money, those who want money. If the cost of getting the money is high, you will get less money, you'll borrow less money. But if the cost to borrow the money is less, you will borrow more money, right? And anything that has to do with the y-axis, nominal interest rate and price levels, will cause a movement along the curve. I repeat, changes in price levels as well as changes in nominal interest rate will cause movements along. However, any changes in real GDP and financial innovation will cause shifts in the demand curve. So when there's an increase in real GDP and financial innovation, there will be an increase in the demand for money, and the opposite is true. Yeah, almost there, guys. Now let's look at the supply of money, right? So the supply of money is influenced by the money multiplier, right? So it is influenced by the money multiplier, and the higher the desired reserve ratio, the lower the multiplier. So remember, I covered this just now. I said that if you have to reserve more with the South African Reserve Bank, there's going to be less money in circulation, and as a result, the multiplier is going to decrease, right? So the greater the multiplier, the bigger the quantity of money supplied. So when the multiplier increases, the quantity of money supplied also increases. So the multiplier is going to influence supply. And supply has a positive relationship with nominal interest rate. The higher the nominal interest rate, the more someone is willing to give you money. If you are putting interest on the loans that you're giving people, if someone is willing to repay the money at 110, you would most probably give the money to someone who's willing to pay a higher price. If you have two people, one is willing to bring back your 100 rand with one as 150, and one is willing to bring back your 100 rand as 110, who are you going to lend? The one with 150. So the higher the nominal interest rate, the more someone is willing to lend you money. And then we say that changes in the nominal interest rate are going to cause movements along the supply curve, and changes in the monetary base. Remember what the monetary base is. It's the coins and the notes that you have in circulation, or that households have, right, that are in circulation. So when there are changes in the monetary base, in the notes and coins in circulation, there's going to be shifts in the supply curve. If there's an increase in the money base, the supply is going to increase, because think about it, there's more money. And if there's a decrease in the money base, there's going to be an inward shift, a decrease, right? And you might have a case where the supply of money is vertical, it is fixed. So when you have something like this, it means that the South African Reserve Bank controls how the money base should be, right? So then we look at what happens when we reach the long run. So when we reach the long run, the inflation is equal to the expected inflation, and the real GDP is equal to the potential GDP. So in the long run, an increase in the quantity of money increases money by the same percentage. Okay, yeah, that's all, guys. So I am trying to push as much as I can so that you guys are ready for the test. Please don't forget to comment, like, and most importantly, subscribe. Bye, guys.